You might be paying 30% tax on your dividends without even realizing it. Yes, even inside of an ISA. If you own shares in companies from the US, any dividends that you receive from that investment will be hit with a 30% US withholding tax, and this is taken at source. That means that before you even see your money, a giant bald eagle swoops down and wraps its talons around nearly a third of it. That's because the US tax rules are the same for anyone who isn't a resident of their country. If you receive income from US based companies, they're taking a slice. While having your dividends picked at by large birds of prey isn't exactly ideal, they at least have the decency to leave any capital gains you may make from these investments well alone. So if you're investing inside a tax efficient account like a stocks and shares ISA, any capital gains you make from your investments into US companies is 100% yours to keep. Now, that doesn't really solve the issue of the US withholding tax on your dividends, but what if I told you that one singular sheet of paper could be the key to cutting that tax in half? The US and the UK have at times had a pretty rocky relationship, but for the most part we get on alright. One of the benefits of this halfway decent relationship is that we have treaties in place to ease taxes like this one. This right here might look like a boring form handed to you by HR before you begin working, but it's actually a money saving machine. It's called a W-8BEN form, and it's simply a way to tell the US Federal Tax Agency, the IRS, that you are not a US resident and that you're eligible to claim any tax benefits your country might receive from tax treaties with the US. If you happen to come across a W-9 form, this is only meant for US citizens and legal residents, so you don't need to fill that out, just stick with the W-8BEN form. Seeing as we get along like a house on fire, the UK has a tax treaty with the US that reduces US withholding tax from 30% down to 15%, but only if you filled out a W-8BEN form to prove that you're a UK resident. You might be thinking this all sounds like a bit of hassle, filling out forms, posting them to the US, waiting months for them to deal with it, and so on, but that's where you'd be mistaken. At no point will you have to contact the IRS directly when completing a W-8BEN form. Instead, this goes straight to the broker that you're investing with, either electronically or by post, and they will deal with everything else. If that still seems like too much to ask, and you'd rather skip filling one out with the aim of claiming the tax back later, you can do this, but really you're just making life a lot harder for yourself in the long run. In order to do this, you'd have to file a non-US resident tax return to get that extra withholding back, meaning you would have to deal with the IRS directly, and this could result in you waiting months on end to see your money back where it belongs. Assuming you do take the time to fill out a W-8BEN form up front, it'll cover you up until the end of the third year after you sign it. So if you signed one in March 2025, you'd be covered up until the 31st of December 2028. It's important to keep a record of when this cover will end though, as if you miss the renewal, your broker will go back to taking 30% of your US dividends immediately. Though it is also quite likely that you will receive reminders from these platforms. They won't really want to take more than necessary, as they probably want to keep that money in your account rather than handing it over to the US government. For all of about 2 minutes of your time, it's definitely worth filling out a W-8BEN form if you have stock market exposure to US companies. But how do you actually do this, I hear you asking? I'll leave a link in the description so you can fill out a form for yourself if you need one, but I'll also run you through it quickly as it's dead simple. Most platforms will also give you access to the form if needed. On line 1, you need to put your name and country of citizenship, then just below this is where you put your permanent address, which obviously needs to be outside of the US. Line 6 is required next, and this asks for either your national insurance number or your unique taxpayer reference, just to make sure you're not lying about where you sleep at night. We're filling this form out to claim the benefit of the US-UK tax treaty, so on line 9, confirm that you are from the UK, and then cite Article 10(2)(b) for the 15% rate, written as I've put it here. Then, all that's left to do is provide your signature and check the box to confirm that you have the capacity to sign the form for yourself, assuming you do of course. Also, when putting the date on the right here, remember that it's the American format, so month, day, then year. Never understood why they do that. Lots of brokers will prompt you to either sign one of these before opening an account with them, or they'll get you to sign one before you buy US shares. But if you've never seen this form in your life, at least you now know where to find it and how to fill one out. One thing that's important to touch on is how US withholding tax works inside tax efficient accounts here in the UK. If you invest inside a stocks and shares ISA, it might seem like you won't have any taxes to pay when using it, but US withholding tax actually bypasses this completely. So even inside one of these accounts, you will still pay the 30% tax without a form or 15% with one. And this is because ISAs protect you from UK dividends tax, but not US dividends tax. Fortunately, the same can't be said for pension products. UK pension schemes, including SIPPs, can claim full exemption from US withholding tax on dividends, and you don't even need to fill out a W8 Ben form to do this. Your broker will handle everything for you. Whether you choose to hold your US shares in a stocks and shares ISA or a SIPP, you're still paying far less in tax than you would if you held them outside of one. If you've already maxed out your ISA allowance for the year and want to buy US shares in a general investing account, the way US withholding tax is taken is a little more complicated due to the interference of UK dividend tax. At the time of recording, basic rate taxpayers pay 8.75%, higher rate pay 33.75%, and additional rate payers pay 39.35%, with the first £500 of dividends you receive being tax-free due to the current dividend allowance, which is subject to change. US withholding tax is still applicable on your US shares, however, the amount you pay will be knocked off of your UK tax bill as a tax credit. So, as an example, if you're a higher rate payer with a W8 Ben form, you might pay 15% in US withholding tax and then the remaining 18.75% in UK dividend tax. However, if you don't file a W8 Ben form, you could find yourself in a sticky situation. The UK-US treaty only allows foreign tax credit relief up to the treaty rate of 15%. This means that if you don't have a form, you will pay the full 30% US withholding tax. On top of that, you would then pay the UK's 33.75% dividend tax, provided you're a higher rate payer. However, instead of being able to claim the first 30% back that you paid in US withholding tax, you are limited to only receiving the treaty rate of 15%, resulting in you paying an effective tax rate of 48.75%, nearly half of your entire dividend income on US shares. So, yeah. If you are investing outside of a tax-efficient account, it is vital that you have one of these forms signed and ready to go. Otherwise, you could incur an unnecessary amount of tax on your dividend income. By submitting a W8 Ben form to your broker, your US dividend income should be taxed at 15% automatically, and you should never need to contact the IRS to file a US tax return. The only time this could happen is if too much tax is withheld on your investments. I.e., you're taxed at 30% even though you filled out a W8 Ben form, but this is very unlikely to happen. So, for just a couple minutes of your time, you can slice the amount of tax you send across the pond in half, and there's really no reason not to do it. If you're buying US shares in a general investing account or a stocks and shares ISA, just make sure you renew it every few years and you'll receive more of your hard-earned income. For those of you holding US shares in a SIPP, you're living the American dream.